Hello, welcome to today's class. We are going to consider asset pricing and management. In today's class, we are going to look at what asset pricing is and how we can manage it. This is the first course in the module Financial Management and Strategy. Introduction. What is asset pricing and management? Let's take some definitions. Generally, asset pricing and management refer to the process of valuing and managing various assets such as stocks, bonds, and real estate. Now let's look at asset pricing on its own. Asset pricing on its own is the process of determining the fair value of an asset. The process of determining the fair value of an asset. Then what is asset management? Asset management involves decision making about how to invest in and manage these assets, which include stock, bond, real estate, precious metals, and any other form of asset in order to maximize returns and minimize risk. Let's take it again. Asset pricing and management is the process of valuing and managing various assets such as stocks, bonds, and real estate. Now, what is asset pricing on its own? Asset pricing is the process of determining the fair value of an asset. Then, what is asset management? Asset management involves making decisions about how to invest, what time to invest, the amount to invest, in what assets to invest, what are the possible returns, how to manage these assets in order to maximize returns and minimize the risks. There are three principles of asset management. The number one principle is the market efficiency principle. The market efficiency principle. The market efficiency principle states that markets, that is financial markets, are efficient, and that asset prices always reflect all available information about an asset or about the assets being traded in the financial market. In other words, market prices are always the most accurate estimate of an asset's true value. This theory makes it clear that the market is efficient, there is free flow of information, and that all actors, all participants, all agents in the market have all the available information in the market. So the prices of the assets being traded in the market reflects the true value of such an asset. The second principle is the risk and return principle. This principle states that the assets with higher risk has the potential of yielding a higher return to justify the investments in such an asset, while assets with lower risk generally have the potential of lower returns. The risk and return principle shows that the higher the risk of an investment, the higher the potential return must be in order to justify the investment. Conversely, lower risk investments generally have lower potential returns. And the third principle is the time value of money principle. This principle or theory states that a naira, a dollar today, is worth more than a naira or a dollar in the future due to the potential earning of that naira or dollar to earn interest over time. Therefore, when valuing an asset, it is important to consider the time value of money. The theory states that a naira today is worth more than a naira in the future due to the potential for that naira to earn interest over time. Therefore, when valuing an asset, it is important to consider the time value of money. Here, we are going to consider asset management strategies. Asset management strategies. The first strategy in asset management is asset allocation. Asset allocation. Asset allocation involves diversifying investments across different asset classes such as stocks, bonds, and real estate in order to minimize risk and maximize return. In this asset allocation is where we will see learn about the concept of portfolio subsequently. So number one strategy for asset management is asset allocation. Number one strategy for asset management is asset allocation, which involves diversifying investments across different asset classes such as stocks, bonds, and real estate to minimize risks and maximize returns. The second strategy is the active versus passive management. Active management involves making specific investment decisions in order to outperform the market, while passive management involves investing in a portfolio that mirrors the overall market. Active management involves making specific investment decisions in order to outperform the market, while passive management of assets involves investing in a portfolio that mirrors the overall market. Then the third strategy is risk management. Risk management involves identifying and managing risk associated with specific investments in order to minimize potential losses. In order to do that, you have to identify the risk, assess the impact of the risk, then control the risk, and review the controls you've put in place to know whether it has resulted in reducing the risk. Subsequently, we will treat risk management holistically. Now, we are going to look at valuation methods, how we value our assets. The number one method is discounted cash flow. The discounted cash flow involves estimating future cash flows that an asset will generate and discounting those cash flows to their present value in order to determine the fair value of the assets. Discounted cash flow involves estimating the future cash flows that an asset will generate and discounting those cash flows back to their present value in order to determine or estimate the fair value of the assets. The second valuation method is called the market comparables. The market comparable involves comparing assets to similar assets in the market in order to determine its fair value based on market prices. This involves comparing the assets to similar assets in the market in order to determine its fair value based on market prices. The third valuation method is the option pricing. This involves estimating the value of an option to buy or sell the assets in the future based on various factors such as the current price of the assets, the strike price of the option, and the time until the option expires. This involves estimating the value of an option to buy or sell the asset in the future based on various factors such as the current price of the asset, the strike price of the option, and the time until the option expires. Subsequently, we are going to look at this aspect of option pricing holistically and in details. Now, what are asset pricing models? Asset pricing models are mathematical frameworks that attempt to explain how prices of assets are determined in financial markets. These models provide a theoretical basis for understanding the relationship between risk and expected return of an asset. Assets pricing model are mathematical framework that attempts to explain how prices of assets are determined in financial markets. These models provide a theoretical basis for understanding the relationship between the risk and expected return of an asset. In this lecture, we are going to introduce such models, about 3 or 4 of such models, highlight them, and subsequently in another lecture we will treat those models in details. But this lecture is just introductory to such models. We will treat them holistically when we look at the portfolio management holistically, capital asset pricing, the capital market theory. We will treat the models individually and in details. The asset pricing models we will consider include the capital asset pricing model, the CAPM. The CAPM is based on the idea that the expected return of an asset is a function of the risk-free rate of return, the assets beta, that is the systematic risk, and the expected return, that is the expected market return. Let's take it again. The CAPM is based on the idea that the expected return of an asset is a function of the risk-free rate of return, the assets beta, that is the systematic risk. You know what the systematic risk is. That is the what we call the market risk and the expected market return. The CAPM is widely used in the finance industry to estimate the cost of equity for a company or portfolio. This CAPM is an important model that I expect you to talk more of in your case study, in your assessment. I expect you to make use of the theory in explaining your findings in the case study we are doing for this course. Then the second model is the arbitrage pricing theory, which is an alternative to the CAPM. The arbitrage pricing theory, that is the APT, assumes that assets returns are driven by several macroeconomic factors, such as changes in interest rates, inflation rates, and economic growth rates. The APT is often used by investors who believe that the CAPM is too simplistic and does not capture all the factors that drive assets return. The third asset pricing model is the Farmer-French three-factor model. The Farmer-French three-factor model builds upon the CAPM by adding two additional factors: the size of the company measured by market capitalization and the book to market ratio, which measures the value of a company's assets relative to its market value. This model has been widely used in empirical studies and has been shown to have better explanatory power than the CAPM. The fourth model is the Black-Scholes model. This model is a pricing model for options contracts that takes into account the underlying asset price, the underlying assets price, the options strike price, the time until expiration, the risk-free rate of return, and the volatility of the underlying assets. The model is widely used by traders and investors to value options contracts and manage risk. In conclusion, asset pricing and management are critical aspects of investing that involve determining the fair value of assets, making investment decisions, and managing risk. Asset pricing models provide a theoretical framework for understanding how asset prices are determined in financial markets, but investors should be aware of their limitations and exercise caution when using them to make investment decisions. By understanding these principles, investors can make informed decisions and achieve their financial goal. In your case study, I expect you to state the limitations of any of the theories or the models you are applying in your case study. You are expected to highlight the limitations of such models or theories. Thank you. See you again in the next class.